All right, let's dive into Scotiabank's Q3 2024 performance and see what's really going on. We're going to really try to figure out if now is the time to maybe think about investing in them.
Right.
And just to be clear, we're not giving investment advice or anything.
Of course not.
We're just going to look at what they've given us and try to break it down.
Exactly.
They've got their earnings call transcript and their shareholder report and even those regulatory disclosures.
Yeah, all the good stuff.
All the good stuff. So we're going to break all that down.
Right.
So first things first, Scotiabank had a pretty positive last quarter.
They did.
EPS growth, positive operating leverage, revenue acceleration even, especially in Canadian banking and global wealth management.
Yeah. And you know what's interesting is they did this in what they called a challenging market environment.
Okay.
Which is basically, corporate speak for everyone else is struggling. So, it seems like they're at least weathering the storm a little bit better than some.
Yeah. So they're holding steady, but are they making like big power moves? Are they playing it safe? What's going on?
Right.
They keep mentioning this shift from volume to value.
Yeah.
What is that all about?
Well, I mean, it sounds a little bit like, self-help guru, but it's actually a pretty smart strategy when you think about it. They're not just chasing after, any customer they can get. They're really trying to attract those high-value clients, the ones that are going to stick around.
Yeah.
And we can see that in the numbers.
Okay.
Their Canadian banking deposits, for example, they shot up by $43 billion.
Wow.
So that tells me that they're attracting the right kind of clientele.
Okay, so they're playing the long game.
It seems like it.
Instead of just like short-term games.
Exactly.
Okay, let's get into the nitty-gritty a little bit, the actual numbers.
Right.
They reported an EPS of 1.63 ROE of 11.3%, 5% year-over-year revenue increase.
Yeah, pretty good.
But what's with this dip in the net interest margin? What happened there?
Yeah, so that was a little bit of a dip, but it's not as bad as it looks, I don't think, because they're expecting it to kind of bounce back next quarter.
Really?
There are a few factors at play. Lower margins in some areas. They've got more low-yielding assets than they used to, but the point is they see this as temporary.
Okay.
They're already factoring in rate cuts, and they're anticipating this rebound.
So they're not just reacting to the market, they're kind of looking ahead.
Yeah, they're thinking ahead.
Which is a good sign for investors.
It definitely suggests a more, proactive mindset, for sure.
Yeah, so they're not afraid of the challenges. They're just kind of like rolling with it.
Exactly.
And speaking of adapting to challenges, I noticed that they're being a little picky about their clients these days.
Oh, yeah.
Even if it means like a small hit to their return on assets.
Right.
Why would they do that?
Well, I think it goes back to that volume to value idea. So they're really prioritizing those relationships that are going to make them money in the long run, right? So loans, investments, wealth management. Right.
And not just, like one-off transactions.
So they're building relationships instead of just, like I said, one-off things.
Exactly.
Okay.
They're trying to build a web of services that all kind of connect.
So they're playing the long game while some banks are like giving out subprime loans like it's 2007.
Yeah, they're playing it a little safer for sure.
But doesn't always lead to big wins, does it?
That's true, and that's where I think this KeyCorp investment comes in.
And okay, yeah, let's talk about that.
Yeah.
That came out of left field a little bit.
It did a little bit.
This KeyCorp curveball. So they're taking a big stake in a U.S. bank.
Yeah, 14.9%.
14.9%. What's the plan?
So it's a two-stage deal. The first part closes this year, and then the second part, if everything goes according to plan, in 2025.
Okay.
And they're saying that it's going to boost their earnings by about $350 million per year once it's all said and done.
Okay.
But the catch is it comes with a $1.6 billion price tag up front.
So it's a big gamble on the U.S. market?
It is a gamble for sure.
Hopefully it pays off.
We'll see. And for investors, that's a big risk to consider.
Absolutely.
So we've got to figure out, how risky is this really?
Yeah, what are the risks and how do they stack up against the rewards?
Right, because there are a lot of risks. They talk about economic downturns.
Yeah, regulatory changes, geopolitical risks, climate change.
Everything.
Yeah, the whole laundry list.
How do we unpack all that?
Well, I think the first thing to remember is that every company is going to have a list of risks.
Right.
Right? It's just how much they tell you about them.
Right.
So the key here is not to get too overwhelmed, but to figure out how they plan on handling those risks.
Okay, so how are they mitigating these risks? Because nobody wants to invest in a company that's just going to crumble
right
at the first sign of trouble.
Exactly.
So what have they got?
So a couple things they've got going for them are, first of all, they've got robust capital ratios.
Okay.
So that's their safety net.
Okay.
They've also they're really big on stress testing, which is basically just a fancy way of saying that they're imagining all the worst case scenarios.
Right.
And then seeing if they can handle it.
They're prepared.
They're prepared.
Yeah. Okay. And that's good.
And then, of course, there's the diversification we were talking about.
Yeah.
They're not putting all their eggs in one basket, right? They're in a lot of different business lines, a lot of different geographic regions.
Right.
So if one area isn't doing so well, the others can kind of pick up the slack.
That makes a lot of sense.
It does.
But I can't help but notice their loan loss provisions, especially in international banking, are going up a little bit.
Yeah, that's true.
Is that something to be concerned about?
It's definitely something to keep an eye on because an increase in provisions like that can sometimes mean there's some trouble brewing.
Okay.
But it's also possible that it's just part of a change in their lending strategy as they're moving into these new markets.
So how do we figure out which one it is?
Right. Well, that's where we've got to do a little more digging, and that's what we'll do in the next part.
Perfect.
Yeah.
So we still need to figure out if those loan positions are a red flag or just like a yellow light.
Yeah. And that's where things get a little bit tricky because it's not always easy to tell from the outside looking in.
Right.
But we can definitely, like you said, dig a little deeper and see what we can find.
Okay, so where do we even start?
Well, I think the first place to look is at the types of loans that they're making in those regions, right? Cool. What industries are they targeting? What are the economic conditions like in those specific countries?
Okay, so like, are they making risky loans in countries that are already struggling?
Yeah, exactly. Are they taking calculated risks or are they, jumping into a burning building?
Right, right. And how do we find that information out?
Well, you can start with their financial reports, of course.
Okay.
But don't be afraid to branch out a little bit. Look for industry analyses, news articles about those specific regions, even economic forecasts.
So do your research.
Exactly. Knowledge is power, right?
Especially for investors.
Especially for investors.
Yeah. Okay, so it's not just about what's in their reports. It's about understanding the bigger picture.
Yeah, you got it.
Okay, so loan loss provisions were on it. We're looking at the bigger picture.
Right.
What about this Key Corp deal?
Yeah.
That seems like a whole other can of worms.
It does a little bit, right?
It seems risky, but exciting at the same time.
It's definitely a bold move.
Is it good for investors, though?
That's the million-dollar question, isn't it? And I think the answer is it depends.
On what?
Well, it depends on your risk tolerance, right?
Oh.
This is a long-term bet on the U.S. market, and it's not a sure thing.
Right.
So you got to ask yourself, are you comfortable with that level of risk?
And how do we even know if it's going to pay off?
Well, you can look at Key Corp's performance, right?
Okay.
What's their market share? Like, what are their growth prospects?
So it's like we're vetting them.
Yeah, kind of like doing due diligence before you get married, right?
Right. You don't just marry someone without getting to know them.
Exactly. You got to look at their financial history. You got to meet their family. You got to make sure they're not a crazy person.
Okay, so we've got to do our research on Key Corp as well.
A little bit, yeah.
All right, so we've talked about some of the potential downsides. The risks.
Yeah.
What about the good stuff?
Right.
What are Scotia Bank's strengths?
Well, I mean, they're clearly doing something right.
Yeah.
They had a really solid quarter,
They did.
despite all the challenges in the market.
Right.
Their Canadian banking division is really strong.
Yeah.
And I think this whole volume to value strategy shows that they're thinking long term.
Right, not just chasing those quick wins.
Exactly. And they're diversifying their portfolio, which is always a good thing.
Spreading the risk.
Exactly. Spreading the risk and hopefully, leading to more stable returns for investors.
Okay, so there's a lot to like about Scotia Bank.
Mm-hmm.
But we've got to remember that they're a publicly traded company.
Right.
Which means they have to tell us certain things.
Full transparency.
Right. But there could be other things going on that we don't know about.
Oh, absolutely.
Things that could affect their performance.
Right. And that's something that investors always have to be aware of.
Okay, so we've talked about the good, the bad, and the unknown when it comes to investing in Scotiabank.
Right. The uncertainty is always there.
But is there anything else that we haven't really touched on that you found surprising or interesting?
One thing that caught my eye was their focus on digital banking.
Oh, yeah, they talked about that a bit.
Yeah, it seems like they're really investing in their digital platforms, and they're seeing some pretty impressive growth in that area.
Which makes sense because everybody banks online now.
Exactly. It's the future of banking.
So they're not just sticking with the old ways, they're innovating.
Yeah, they're trying to stay ahead of the curve.
And for investors, that's got to be a good sign.
It could be. It depends on how you feel about change, right? Some investors are going to love that they're embracing new technologies.
Right.
Others might be a little bit more hesitant.
So it comes back to risk tolerance.
Always.
Okay, so we've covered a lot of ground here. We've looked at the good and the bad, the risks and the rewards.
Right.
And hopefully we've given our listeners a lot to think about.
Yeah. I mean, at the end of the day, the decision of whether or not to invest in Scotiabank is up to them.
Right. We're not giving investment advice.
Exactly. We're just trying to provide some information and some food for thought.
But it's important to do your own research.
Absolutely. Don't just take our word for it.
And make the decision that's right for you.
Exactly.
It's like we're giving our listeners a little toolkit
to
go and make their own decisions.
Exactly. And one of the most important tools in that toolkit is understanding how Scotiabank manages risk.
Because it's not just about seeing the risks, it's about knowing how to deal with them.
Right. You could have all the warning signs in the world, but if you don't know what to do when you see them...
Yeah, it doesn't really matter.
It doesn't really matter, and it seems like Scotiabank is putting a lot of thought into this whole risk management thing.
Okay. Yeah, let's talk about that.
Like we said, they've got those robust capital ratios.
Right, the safety net.
Exactly. And they're doing a lot of stress testing.
Right. Trying to anticipate those problems before they happen.
Exactly. And then, of course, you've got the diversification.
Right. Spreading the risks so one bad apple doesn't spoil the whole bunch.
Exactly. It's like having a good mix of investments in your portfolio.
Okay. So they're taking steps to mitigate risk, but at the end of the day, there's always a chance that something unexpected could happen.
Oh, absolutely.
I mean, who could have predicted the pandemic?
Right, or that pigeons would develop a taste for debit cards.
Exactly.
You just never know.
So how does an investor deal with that uncertainty?
Well, that's where due diligence comes in.
Yep.
You have to do your research, you have to understand the risks, and you have to make sure that you're comfortable with them.
Because every investment has some level of risk.
Exactly. There's no such thing as a sure thing.
So for our listeners who are thinking about investing in Scotiabank, what's the bottom line?
I think the bottom line is that Scotiabank has a lot of potential. They're a strong institution with a solid track record, but they're not without their risks.
Right.
So do your homework, weigh the pros and cons, and make the decision that's right for you.
And don't forget, this is just one piece of the puzzle.
Exactly.
There's always more research to be done.
Always.
We've just given you a starting point.
A jumping off point.
So keep digging, keep asking questions, and keep learning.
Absolutely.
That's how you become a smarter investor.
And that's how you make informed decisions about your money.
Exactly. Well said. That's all the time we have for today, but we'll be back next time with another deep dive.
Looking forward to it.
Until then, happy investing, everybody.